Welcome to our viewers. I'm Tim Coughlin, along with Steve LaRosa, and we are pleased to bring you our video presentation of Edgemoor Investment Advisors' first quarter 2024 report. Our agenda is to review the financial markets in the first quarter of 2024, to explore the inflation and interest rates, including the Federal Reserve Bank's federal funds rate future movements, to discuss the U.S. economy and its outlook, to discuss our portfolio approach, and to present our analysis of a couple of stocks. We begin with Steve for his presentation of current market and economic conditions and our outlook going forward. Steve?
Thank you, Tim. The stock market carried its strong momentum from late 2023 into the first quarter of 2024, driving most equity market indices to record highs. Market gains were driven by the combination of a resilient U.S. economy, solid corporate earnings, and continued strong momentum in the tech sector. The rally also broadened its scope, benefiting financial, energy, and industrial stocks, many of which had been left behind in last year's rally. This broadening strength is considered a positive indicator for a longer, more sustainable rally. The strong first quarter gains also came despite several factors that could have caused stock prices to fall, including stubbornly high readings on inflation and diminished expectations for significant Federal Reserve interest rate cuts beginning in the first half of 2024. Somewhat surprisingly, the market once again shrugged off these potentially negative factors. The S&P 500 index posted a 10.6% total return for the first quarter, its best first quarter since 2019. The index peaked at 5,253 late in the quarter, a level which many analysts had predicted might not be reached till the end of 2024. On the other hand, the bond market reversed gains from the fourth quarter of 2023, posting a negative 0.8% total return in the first quarter of 2024, as a slight increase in interest rates caused bond prices to fall. The Federal Reserve held its benchmark Fed funds rate steady at a range of 5.25% to 5.5% during the first quarter, continuing a pause in interest rate activity that began in mid-2023. In response, analysts and economists revised expectations for 6 rate cuts this year to 3 and pushed out the expected beginning of easing monetary policy to June from March. As a result of this delay, benchmark Treasury yields began to tick higher, with the 10-year Treasury yield notching a year-to-date high of 4.3% at the end of March, from 3.9% at the end of December. Bond prices fall as interest rates rise, which resulted in the negative total return for the Barclays Aggregate Bond Index during the first quarter. The Fed's cautious stance on cutting rates early in 2024 came after several consecutive elevated inflation reports since the start of the year. The Consumer Price Index, or CPI, rose 3.1% year-over-year in January and 3.2% in February, exceeding expectations. The March CPI reading, which came out after quarter end, also surprised to the upside, posting a 3.5% year-over-year increase. In addition, core CPI, which excludes volatile food and energy prices, also remained elevated at 3.8% in March, matching its 3.8% reading in February. Absent a meaningful reversal in the core inflation rate to a level closer to the Fed's target 2% rate, it seems likely that the Fed will remain cautious about cutting interest rates until at least the latter part of 2024. Despite elevated inflation readings, the U.S. economy has remained remarkably resilient, characterized by continued low unemployment, solid GDP growth, and strong corporate earnings. The U.S. unemployment rate fell to 3.8% in March from 3.9% in February, remaining consistently in the sub-4% range as it has for the past 25 months, displaying incredible stability during that time frame. Job gains have occurred in the healthcare, government, hospitality, and construction sectors of the economy. Median hourly wage growth slowed slightly to 4.1% year over year, but remained above the current inflation rate. U.S. GDP grew at an annualized rate of 3.4% in the fourth quarter of 2023 and is currently projected to top 2.8% in the first quarter of 2024, according to the Atlanta Fed. Much of the growth has been driven by U.S. consumers, who collectively increased spending by 0.8% in February, following a 0.2% rise in January. This remains an important metric since consumer spending accounts for more than two-thirds of U.S. GDP. Corporate earnings have also exceeded expectations, with fourth quarter S&P 500 index earnings growing 7% year over year. First quarter earnings are currently expected to accelerate 6.5% and are forecasted to increase 12.5% for 2024, according to S&P Global. U.S. productivity has also showed gains, increasing 3.2% in the fourth quarter, significantly higher than the 1.5% average productivity increase over the past decade. The gains have come about in part from investments in technologies and capital equipment that businesses have been more willing to make now that recession risks are fading, which should help drive growth in corporate earnings for the remainder of the year. Our outlook for the economy and markets in 2024 remains cautiously optimistic. We believe that if the economy continues to grow at a solid pace and corporate earnings continue to rise, then stocks should extend their gains this year. The equity rally has broadened beyond the technology sector. A broader market rally is generally considered stronger and more sustainable. But of course, there are risks, as there typically are. The geopolitical landscape is uncertain, with an expanding crisis in the Middle East, the ongoing war in Ukraine, and serious economic issues in China. Closer to home, the continuing gridlock on Capitol Hill and the 2024 election cycle will most certainly pose a near-term distraction. Given those risks, pullbacks or minor corrections in stocks are common from year to year and are often healthy in the context of longer-term returns. Overall, we maintain a positive long-term outlook for the U.S. economy and markets. Now I will turn it back over to Tim for a discussion of portfolio implications and two securities we are currently buying for client accounts.
Thank you, Steve. As we consider current economic market conditions, we continue to find pockets of good stock investment opportunity. We continue to invest some cash in short-term treasuries and money market funds at 5% yields, and we continue to maintain our long-term and value-oriented investment philosophy for the majority of our investments. I am going to present our analysis of two stocks we are currently buying. The first is Lennar Corporation, and the second is Taiwan Semiconductor Manufacturing Company Limited. Lennar Corporation is one of the two largest home builders in the United States, as measured by the number and dollar value of homes delivered. Lennar builds a variety of homes at multiple price points, including entry-level homes, step-ups, multifamily, and retirement homes. Lennar also provides mortgage financing, title insurance, and closing services. Total revenues topped $34.2 billion in 2023. Over the past several years, Lennar has shifted to a lighter land acquisition strategy, which reduces the amount of capital tied up in land on its balance sheet. This has resulted in meaningfully higher cash flow, returns on capital, and total shareholder returns. Significantly, higher mortgage rates have tested home buyer sentiment and kept a portion of potential home buyers out of the market. However, Lennar's size, scale, and execution have allowed the company to manage through the current interest rate cycle better than in past cycles. The company has increased production of entry-level homes to meet demand from first-time home buyers despite higher mortgage rates. Moreover, we believe that Lennar is well positioned for when central banks ultimately begin to loosen interest policy, which will have a positive impact on housing affordability by lowering mortgage loan rates. Lennar's balance sheet has strengthened over the past several years, ending the most recent quarter with a $5.2 billion of cash, $26.6 billion of shareholders' equity, and $4.5 billion of debt, which has been reduced from over $7.5 billion in 2020. The company has increased its dividend at a 25% compounded annual growth rate over the past 10 years, and dividend increases are expected to continue. We believe Lennar stock is a good buy at 11.5 times forward earnings for a best-in-class home builder that will benefit from the continued growth in the U.S. housing market. Taiwan Semiconductor is the world's largest chip manufacturer with a nearly 60% market share. The company's scale and high-end technologies allow it to generate healthy profit margins despite stiff competition. The sources of Taiwan Semiconductor's economic advantage are its size, reputation, technical barriers to entry, and high capital requirements. The company is a market leader in advanced node chip innovation and production. Taiwan Semiconductor is benefiting from its technological superiority and a multi-year tailwind in artificial intelligence technology. AI chip supply and demand dynamics remain favorable for Taiwan Semiconductor as demand far exceeds supply. Multiple secular forces, such as increased demand for research and development, advanced technologies, amplified investments in process enhancement, accelerated accumulation of talent, renewed emphasis on national security and onshoring, and cultivation of strong relationships with industry giants should result in long-term growth for Taiwan Semiconductor. Taiwan Semiconductor has a strong balance sheet and generates robust cash flow with a $23.7 billion net cash position and a $12.1 billion in annual free cash flow. The company currently returns cash to shareholders via dividends, and its outlook for dividend increases is excellent. Taiwan Semiconductor shares currently trade at 22 times forward earnings, a modest discount to its 5-year average of 24 times. Due to its economic strength, attractive valuation, long-term growth prospects, and status as an integral part of the global electronics market, Taiwan Semiconductor has become an excellent investment opportunity for investors to gain favorable exposure to the fast-growing AI and chip markets. Steve and I have now completed our report on current economic investment market conditions and 2 stocks we are currently purchasing. Thanks for tuning into our report. And if you have any questions or comments you would like to talk about, just give us a call.